Hello everyone, welcome to Hawkeye Traders. My name is Randy Lindsay, host of today's live presentation. I'm here to educate and inform you on the proper use of Hawkeye on the live edge of the market. Apologize for my slightly tardy start this morning. I'm about 3 minutes late. Apologize for that. I was running a little bit behind schedule, but I'm trying to get caught up now. So thank you for being here. I'll get things going as soon as we can. I want to make sure that everyone here knows that we are not registered trading advisors. We are here for educational purposes only, so we can only promote and give you information and education based upon the use of our software in the market. We'll show you how we trade with them and use them. We want to make sure and um, teach you the proper methods and concepts and how to set up and use the software as best as possible. I want to make sure that you understand and know how to use that this is for education, not for advice. We are not an advisory service. We cannot tell you whether to buy or sell any of these instruments. Uh, Make sure you understand and know that futures, stock, forex, commodities, and cryptocurrencies have a large potential for reward, but also have a large potential for risk. Make sure that you understand and know the risks involved. You are willing to accept them if you're going to invest in these markets. But please don't trade with money you cannot afford to lose. Please use common sense and get advice from a competent financial advisor before you start investing in these markets or trading in these markets. Past performance of any trading system methodology is not necessarily indicative of future results, so make sure you do your due diligence and homework beforehand before you make any type of investment in these types of systems. Never trade in a live account until you have first proven you can consistently and profitably trade simulated. All right. If you have any questions or comments, then please enter them in the questions pane on the GoToWebinar panel, and I'll be glad to get to them in the order that they're received. I'll be going through the whole suite of Hawkeye software this morning on the TradeStation platform. This is the last Wednesday of the month, and so today we'll be dedicating the demonstrations to TradeStation users. Toward the end of the broadcast today, I can always entertain questions on the other platforms. If you have the questions on TradeStation, NinjaTrader, MetaTrader 4, or TradingView, then I'll be glad to go over those. But for now, we'll be focusing it on the TradeStation platform. Also, for those of you who are Tomahawk software users who have subscribed or who own our Tomahawk software, we are going to be integrating that now with our Wednesday training session. So if you do have any Tomahawk questions as well, then today would be a good day to ask those as well. I'll be glad to review and go over those. All right, so I'm showing my TradeStation platform. I'm using TradeStation 9.5. I've not upgraded to 10 yet because there's still a lot of bugs. So I always wait for the bugs to be ironed out as much as possible before I start upgrading. As a matter of fact, I waited so long to go to 9.5. I used 9.1 until they basically forced me to go to 9.5. But 9.1 is still available, and I'm going back to it. But 9.5 is stable enough now so that it doesn't present any real issues. And they've worked most of those out. So I like sticking with ones that are stable and short-lived. So the setup I have here, I have 3 time frames set up with a longer time frame chart. So as you can see, I have 4 charts on my screen. I can, if I need to, just simply trade off of a single chart. It makes things easier. It helps me to see alignment and everything. So when I see, like this morning at 01:30, if I were awake, if my head wasn't already on my pillow, then I can see volume is telling me that the S&P 500 is going into some weakness. Prior to this time, I was seeing a consolidation all the way from the Asian session. You can see that you got a nice triple top coming in 7:30. The Asian session opened up. Price action traded sideways pretty much during that entire period of time. But as this failure came back up, I started to see some extremely large selling pressure at the top of this run. So looking at this gave a very good indication that there was a downward push. So when that downward volume right here started to come in, I started to see my second time frame volume go dark. Then I started to see third time frame volume. I knew something was awry. I can see that something is going against the direction that is being portrayed. So when the volume and price started working together, the roadkill gave a really sweet entry point at this level here to say get in. Instantly, it pulled against you. Well, it only went to the stop, of course. It was a corrective move. As we know, prior support becomes current resistance, and current support is prior resistance. So as we were hitting resistance and we broke through the consolidation range that was there, price broke through, came right back up, retested. Okay, that is a known level. Price broke through, came back, retested it, and then continued to go down and make new lows and continue to make lows. So yes, this was an initial entry signal, got you in at what you would say would be a low, but if you had followed your rules, the price would have been sufficient to hold you in and to continue with that. And then if you missed the first entry, here was another signal for a secondary entry after the correction, and at this point, continue to trail and give you 3, 5, and even 7 levels of profit off of that trade. Coming back into this reversal into this morning, then you can see that there was not a clear signal, that there was an initial entry here, initial alignment here. So this is a great point right here and right here to have gotten into the trades this morning. Very minimal upside potential, but the 8 o'clock news that came across, a lot of information that came across the news and channel this morning propelled this up into bullish range and bullish activity. So all the downward move was very, very quickly corrected from the upward move up. Hawkeye is again there, sitting there showing you the initial entry points for that, giving you a signal for this point here to enter to the long side with a gradual risk reduction, but still a stable entry point and continued trend run. So Hawkeye is a suite of tools that helps you to identify, enter, manage, and exit trades in a consistent and definitive way. The tools that I'm talking about, the Hawkeye trend, are a series of trend dots that follow a smoothed average price line, uses standard deviation price and average true range to determine whether price is in a downtrend signified by red, an uptrend signified by green, or neutral or congestion signified by white. Okay. So whenever you see white price bars, white trend dots, then you know you're in a consolidation area and you need to look for the break of that. We have teachings in our resource area for all of our members that show you how we use our tools to enter, how we use our tools to exit, and how to identify the phase of the market that you're in, whether you're in a trend run, whether you're in congestion entrance, consolidation, exit, or reversal. So all of those tools are available for you if you are a member of Hawkeye. This is just the S&P on a 3-minute chart. There's a lot of interest in the NASDAQ recently, so you can do the exact same analysis using NASDAQ. Okay, a little bit cleaner entry on this point. Initial signal didn't come until right about here, and so that was a little bit cleaner on the entry side. Another initial entry point came in here, so that was a little bit cleaner entry also. And then the entry off after the news bar gave you an initial entry right here, which again was a little bit cleaner entry. So the NASDAQ itself overall gave a cleaner entry than the S&P, but the S&P is a little bit bigger and a little more heavily traded, but the NASDAQ seemed to be a little more tame. So this gave quite a few opportunities to take and to see that as it's set up. Right now, it's on a trend run up. It is closing down below the trend dot. The trend dots are starting to go sideways, so we're looking like we're starting to enter into a period of congestion right at the open of this market. So price peaked out and is trading back down into the open. but it is in a trend run long, and we're waiting for the longer term trends to show us because we're seeing that we've got solid momentum and volume still on the longer time frames, but we're looking for volume to come back in line with that idea. So the tools we were looking at, the trend and stops. The trend shows the direction of the trend. The stops themselves are automatic trailing stops that pull out a specific distance from price until that price starts to consolidate. And you can see that that price levels out, and it keeps you safe until that price is violated. So it gives you the distance from the price that you need in order for the trend to develop. And once it's developed, it pulls in really tight until that trend starts to get you out. And then it keeps you safe by giving you a definitive exit point if those exits are outside of your regular profit take points. So the trend and stops is one of our primary tools that we use to help us to enter and manage trades. The second tool is the Hawkeye volume. That's this tool right here. The Hawkeye volume is a series of tools which show us buying pressure shown by the red, selling, I'm sorry, let me correct that. Buying pressure, which is shown by green, selling pressure, which is shown by red, and no demand or neutral, which is shown by white. A neutral bar is just showing that there's an equal presence of buying and selling pressure on the individual price that's occurring at that point. So we are looking at this to give us indications of the direction in the market. So when we couple price with volume, that helps us to understand where we are in the market and the potential direction that the market might be turning. The magnitude of the volume also gives us a lot of information as to who's in control of this market, and also a little more information on the potential direction of the trade. We do teach this in our training classes in our rooms and in our material and handouts. So trend and volume are the core components of everything that we do. We are a volume company, so everything that we trade is based upon volume. And we are currently developing a whole suite of volume-related tools, and I'm calling it the next generation, but we're looking at a clever name to pull it out. But we're going to be posting those new tools out here real shortly that show a completely different way of looking at the markets through the eyes of volume. And so it'll be a totally different methodology as well. So right now we're using a method of entry which is definitive based upon price and volume. It's a very line item. This other way is going to be very predictive. We're going to be looking at it purely through the lens of volume, and we're going to be looking at the market completely differently. So I think you're going to be really excited about the new changes and the next generation tools we're coming up with. And those who are very set up and comfortable where we are now, that's great because we're not going to be doing away with anything. We're just going to be enhancing what we've already got with a new line of software and tools to help complement that. The tool that I like the most is called the Hawkeye Roadkill. The Roadkill simply just takes the Hawkeye trend and the Hawkeye volume and displays it on the chart for you in a nice linear format. But this Roadkill isn't only for the time frame you're looking at, it's for any time frame. So I'm showing right here the trend and the volume of my 6-minute time frame chart. So see the bar interval here, slow bar interval? That's bar interval times 2. I'm taking the 6-minute chart, the trend off of my 6-minute chart, and the volume off of my 6-minute chart, and I'm displaying it here on my 3-minute chart so that I can see at what point do the 6 and 3-minute charts align. Where do they agree? When they do, then the roadkill signals you when that alignment occurs. When that alignment occurs, those are usually at very good trade opportunities. So the roadkill is an excellent tool to show us trend and volume of the longer time frame, the slower chart, with the trend and the volume of the faster chart. An excellent tool to help you to see and to make sure that you stay out of chop, that you get in line with the longer term trend and the exact opportunity to do that. So when you duplicate that, here's a roadkill here and here's a roadkill here. You duplicate that on a single chart, then you can have multiple time frames at the same time. So here I have another roadkill, but this one is set up to look at 4 times the time frame. So 4 times 3 is 12. So I'm looking here now at my 12-minute volume, which is this chart right here. This volume here is replicated on this chart to help me to see the alignment. And it doesn't show you the magnitude of the volume, it only shows you the color of the volume, but the color is the only significant part because that's telling you that there are buyers present at this point or sellers present at this point. Or when they align, when everybody becomes buyers at one point, then it signals when that alert occurs, when that condition occurs. And those are usually extremely good entry opportunities on a trend. So that's why I like the roadkill, because it gives me the opportunity to trade off of a single chart, even though I'm pulling information off of 3 different charts at the same time. If you have the Hawkeye standard package, then you're looking at Hawkeye from without the roadkill on it. Then you're looking at trend, volume, heat map on 3 different time frames. And so you can still look for the alignment of those. And so if I were to look at a global setup, then you can see on 3 time frames whether I have an alignment of trend, volume, or heat map on any of these time frames. So you can see that my 3rd time frame, I'm in green volume. My 2nd time frame, I'm in green volume. My 1st time frame, I'm in green volume. I've got a green or dark green heat map here on my 2nd time frame. So everything looks good. This looks like a very great entry point based upon our 3 time frame, 3-step entry exit methodology. So this is a great place to enter and to start managing your trades. When the trade gets violated like it was here, then this is a great place to exit the trade and to look for other opportunities. Because when you see large volume spikes like this of opposing volume, then that tells you that that is a great place to take profits or to exit the trade. Move on. Look for a new setup or a new opportunity. But this was a great place to enter, profit take, a great place to exit. So the roadkill is an excellent tool to help you pull all 3 of these charts together into a single chart that allows you to see the alignment of those time frames on multiple time frames. And it can be any time frame. I'm looking at a 5, 15, and 30-minute chart, but you can see that the same setup can work on a daily, a weekly, or a monthly, where I have multiple roadkills set up that show me a 2-day and a weekly setup on a single daily chart. So whether you're trading longer term or shorter term, Hawkeye is very, very versatile in helping you to set up a trading plan that meets your particular trading style. Okay. Any questions so far? Yes, on this NASDAQ, the volume was the key, because when you're looking at predicting future direction of price, volume really is the only leading indicator to help you get there. So when you signal, when you see that volume is starting to push up and give you a false breakout, when you see a large number of selling pressure coming into an already lethargic buying volume, that's a real clear sign that the sentiment is for reversal. Likewise, after the correction or the reversal has occurred, you can see that volume does the exact same thing. You start to see an extension of price. You can see opposing volume starting to come in, where you can see that the price and volume failed, even with very healthy volume levels. They still failed, and you can see that price came right back in and started to respond, was retested, and then the bullish run came back in. But then here it is again. You start to see price levels that have been attained that become extremely attractive to sellers. And once you see selling activity coming in, you can see that that push is now starting to be corrective in nature. So as the price is coming down, you can see that we're starting to see a rise in volume. But now, as price is stabilized within that wide bar, um, we've got to see that initial push down will be sustained. If it's not, then this will be a failed breakout attempt. We might clearly go into a consolidation. We might have to retest this, or it might continue and break below the 7,000 mark and continue down again. So from my perspective, this right here was an excellent opportunity to take any profits that you might have taken on any type of an entry, either here or on your reversal signal here. And volume was the one that signaled that and led the way. All right, any other questions along the way? What is the spaghetti? Oh, that's this chart right here. This is the fat boy. What I'm looking at on the fat boy are, let me format the symbol here. I'm looking at the futures symbols on a longer time frame. So this is a daily chart that I'm looking at the S&P, the NASDAQ, gold, the Dow, the Russell, and crude oil. And so from that, I can get a pretty good indication of what the market is doing and the direction that the market is gaining energy or losing energy. Is the market correlated or is it decorrelated? Overbought? Is it oversold? So this is an excellent tool that gives me answers to all of those questions right now. Crude oil right now is building strength. It's come from a region of extremely being oversold to it's starting to become very strong and potentially overbought at this point. Okay, the middle line is fair value. So when you see things oscillating around fair value, it's price will always seek fair value. When it gets out of hand, it always tends to come right back into fair value. So as we see now, gold and the Dow and okay, thank you. Let's close that for now. I don't want to update. Sorry about that. We got the gold, you got Dow, the S&P, the NASDAQ, and the Russell. All are trending very nicely with weakness. And they're showing that there's a lot of weakness into this closing of June. But usually when things become oversold, they tend to start turning and rallying back up again. But that doesn't necessarily mean that. It just means that right now there's a steady stream of weakness coming into all of these markets, and just the opposite is occurring in crude oil. And you can see those a lot in the charts that you can see along that. So probably since the 14th of June right here, we've topped and double topped with failure, and so that's right at the time that we started seeing all the weakness coming into that market. The strength that was building up to that point peaked and then started turning just after the 11th, and that was right at that level. So longer term crude oil, yeah, I'll be glad to show that. So longer term crude oil, you can see that the rally for crude began just about the 9th of the 10th and has really consistently been building since that point. Okay, you can see where is the 10th or 11th? There's the 8th, 9th, there's the 11th right there. You can see at that point, price had bottomed. We got a pivot. We expect from a pivot to see at least 3 to 5 price bars of push back up, isolated lows. And then we started to see a decline in selling pressure. Okay, when you see a declining volume and prices continuing to drop, that should be a clear sign that directional there's weakness in that direction of the market, and so there's going to be a change. So when price corrected, volume was not enough to correct that. So as price came back down and started to increase, that failed. It created a new low, but at low, it never closed below it. You can see it was just a wick. So this was a sign that the market was stretching and seeking for a lot of sellers, or even trying to trap sellers into this market and then very quickly reversing back up again. So this was a failed breakout attempt, a false breakout, and a double bottom. You can see very clearly that once price came back in buying volume, it became very responsive. So once that buying volume came back in again, all the selling volume that was there, it still was not responsive because the price we weren't making new lows. So it's telling you something right here that this activity is not enough to sustain a continuation of a down move. So you're looking long from that point. So when the green volume starts coming back in, you start to see trends and pushing in that direction. That's when you want to start making long positions on this. So looking into the daily charts, from the daily chart, that helps you to see directional intent. And so you can go into your faster charts, pull up your crude oil intraday, and then you can see from your faster charts, ever since the 11th, you can start looking for trends that are going long. So if we go back to the 11th, if you took the long trends, 13th, 12th. Okay, so here congestion, consolidation, congestion, push down. This was that last attempt to pull back down again. Came right back up again, consolidation, and then there was a big rally. And so any trade you took that was to the long side then would have been in the direction of the longer term trend, and then that one started building a nice trail of demand zones. Anytime you see a trail of demand zones, you know you're in a nice strong bull market. When you see a trail of supply zones, then you know you're in a nice strong bear market. And so those are the indications that you're looking for on those. Hourly chart, and then we're going into the intraday time frame charts. Uh, Signals are very clear when alignment occurs. 20 cents is a really good trade in crude oil. Here's another 20-cent trade right here. This one is looks like about a 60-cent or 70-cent trade. So the opportunities are ripe if you trade in the direction of the prevailing trend. If you start to trade opposite to that, then make sure that you take much shorter profit targets. Instead of taking 20 cents, take 10 cents. Instead of taking 60, take 30. Just be a little more conservative on your profit takes. When you see price extensions like this, then take profits at these points or wait for the price to return after consolidation and it starts to return in line with the direction of the trade, then get back in the trade or add back to your position. There's nothing wrong with taking profit off the table. Nothing wrong with getting back in and adding to your open positions either. But the tools are set up so that it helps you to see and to know when the ideal points of entry or exit are, regardless of the market, regardless of the time frame. Chris, so on the crude oil, are those buy sell points on a daily basis where it is overbought or oversold? They can be, yes, because if you're looking at that fat boy daily, the overbought, oversold, yes, if it becomes overbought, you cannot trade directly off of this because, like most indicators, this is a lagging indicator. It shows you building strength or building weakness in the chart. If you set it up properly, then it can be somewhat leading, and then it can give you, because we see energy in or out of a market occurs prior to sometimes price action, but in general, it's a lagging indicator too. So like most indicators, they are lagging. The only real indicator that's out there that is not lagging is volume, because volume shows you what's going on right now. It shows you the future intent of, and the price just reflects and responds to the activity that's occurring in that volume, in that time it sells. So once you have that information, the everything else is really just lagging. But properly timed, you can see that the change in the energy or the oversold nature of crude oil at this point, like we said, occurred right around the 8th of June. but you didn't see any real price action until around the 18th of June. Okay, so this really did show you that the direction of that market was changing. You just didn't actually see the result of it until later on. So there are some direction. If you start to use this to help you say, okay, I'm going to buy at that point. Well, if you had bought at the 11th, well, that was the 8th, 6th, 7th, 8th, you can see that would be a pretty good point, but there is still some pain involved in that. It's not the ideal location. There are a lot of people who do use this to help them to judge or to filter their trades, and that's what I think it's best for. I think this is best for helping you to filter your trades or to help you to have a sentiment on the directional intent of the market. So yes, oversold, overbought can help you, but definitive signals help you better. Can I show some forex smaller time frames? Says Ernest. I'll be glad to. All right, here is a 5, 15, 30, 60-minute time frame setup using forex markets. These are the Hawkeye tools, trend, volume, and heat map on my 5-minute, 15, 30-minute, and 60-minute, and I have the Hawkeye zones shown on the 60-minute chart, showing my supply and demand zones, showing the locations that we expect to see that. So when we see the same signatures that we see on price in any other direction, then we know the directional intent and where we're looking at that. So longer term, looking at this euro US dollar, looks like we're in a pullback to a known demand region. You can see that this is a support. Price is pulled back into that support range. A break of that will give us a definite directional goal or target of 115. But right now, what's that, 115.75 to a 115.30 is the gap that we have. But right now, that's the support. We're looking for this to start showing whether that support's going to be held or not. But right now we are in a downtrend based upon hour, and then based upon that, you're looking to trade downtrends on your faster time frames. Okay, so initial entry came earlier this morning in the London session. You see the London session opened right here with a lot of price rallied up to a certain point, failed, pivot high. We're looking 3 to 5 price bars, consolidation. There was your initial break. Did that break align with your second and third time frame? If it did, then that gave you an initial entry right here. That initial entry was tested and then went into profit 2 times, 3 times, and is still in profit and is still in trend waiting for continuation. So based upon your rules, if this were an initial entry signal here, then using your zones, you would have been able to take 1, 2, and 3 levels of profit based upon your level rules. You would have taken a level 2, level 3 minimum based upon a single level of risk. After a period of time, your stop would have followed the Hawkeye stop right down to this point, so your risk would at certain points would have been very small. And then as it expanded back out again, it would continue to hold you into that trade until it exits. Right now, you're still in the trade, but if it hits the stop or violates that trade in any way, you're not exiting the trade simply because you see the volume. You would exit the trade because you have a definitive exit rule. The Hawkeye Fat Man is a unique tool in that it shows you relative strength of individual currencies. So the red line right here you see is the Australian dollar, the yellow Canadian dollar, the cyan line US dollar. So you can see there's a trend of strength in the US, Canadian, Australia, New Zealand, but there's a trend of weakness in the yen, the euro, and the pound. So trading these 3 or 4 pairs against those 3 pairs would give you the greatest opportunity for capturing profits in this market. So the trading short the euro US dollar is in your favor. We already saw that from the direction of price from our 60-minute trend from the other software. We already saw from volume that it was telling you uh, right at midnight last night that the market was going to be going down. So actually, it was the previous night from the 26th. This was last night right here. But you can see 2 days ago that the directional intent of that U.S. euro U.S. dollar was down. So the fat man was just sitting here confirming that for you this morning. It had cycled back into some fair value, could not rally, turned and started to go right back down and came back now into an oversold condition. Now we are oversold. We are in a demand region. We still have dollar strength pulling in. Will it be enough to cause this to continue to go down or not? We don't know. What we do know is that we are in a current downward trend and we are holding because we are in consolidation. If the consolidation breaks against us, we exit the trade. If the consolidation breaks in our favor, we continue to hold or we can add to the trade regardless. The Aussie, yeah, so looking at something like a pound Aussie, US dollar, US dollar pound, or a US dollar yen, all would be potentially trending markets. Let's see if we can find that. Yeah, here's your pound Aussie right here. Looks like it's already an 18 trend short. Weakness coming into the market. You can see peaked out several times. That was last night. Right towards the entry, right as Australia and New Zealand started waking up and getting into the markets, price traded back up into this, and then boom, right there. This was a high stretch to try to trap buyers into a fake breakout, and then price pulls down pretty quickly. It holds, consolidates in a downtrend. You can see that downtrend was already established right here. Hawkeye went red, but then it went into consolidation. Okay, broke back down. Okay, this would have been a great profit point if you were trading it at this time. This was just right after the London Open. All right, but then the market goes right straight into consolidation again. That consolidation range was broken here to the downside, went right back into consolidation, and then it was broken again by the news this morning. Again, still letting you know ahead of time that there was still a bias toward the downside and that holding to the downside with a very short risk to the upside was the directional intent of the market. So that would have rewarded you with the 178, 179 entry with the 178 too. So that's a good 80, 90 pip move on that pound Aussie. Aussie yen, another good pair. Absolutely, that's a carry trade. That's the one that you want to be in if the markets are starting to destabilize. So that would be another good one to look at. The US dollar yen, yeah, we were looking at that. US dollar with strength, the yen with weakness, so you're looking long on that. So you're looking at the same setup where you're identifying building volume coming into this market, buying volume. Here is a directional intent right here, buying or selling. Price failed to go down and then continued to go right back up again. Here where you can see that price came down to demand on that pull down right here, came right into that demand zone, bounced right off of it, and then rallied right back up into a supply zone. So the tools are here to help you to make good informed decisions. So seeing the time frames of these turns, seeing that you've become strong or weak to help you to get in front of and look at the right trades. You're not going to waste your time with the pound euro, okay, because you can see that they're trending in the same direction. Or if you're looking at the Australian Canadian, those are trending in the same direction. Those are probably not going to yield very good results. But you look for the pairs that are opposing, have really nice trends of strength versus weakness, weakness versus strength. And those are the pairs that will give you nice tradable trends. What is a definitive entry signal? Okay, like right here. When you see alignment of the trend, volume, and momentum, okay? That is what we refer to as a definitive entry point, where the price has gotten to a point where the trend can be easily identified as up. Now, to check that, you always look at your second time frame. At the second time frame, we have a methodology that we refer to that we need to see that the momentum and volume on the second time frame agree with the build of potential direction in the first time frame. So we look to our second time frame chart to see at that time, is there alignment with the volume? So two ways to do that. One, you can just go and set your cursor to a global mark so that at this point, when you see alignment here, you want to see green volume. So here, boom, you've got green volume building. Third time frame, there you've got green volume on this price bar as well. So price is telling you that volume is there. But the second time frame is saying the momentum for that move is still, you're still on the downside. You can see structurally you have a lower high, lower low. You've got another lower low, you've got another lower high. So structurally you are still continuing down. It has not broken that downtrend. So this basically saying this is a risky entry. So our three-step entry method does not allow you to take an entry to this long trade. Even though it's a good entry, it's saying, wait, it hasn't fully set up yet. And sure enough, you can see there was still more correction in that. It peaked, came right back down again, and then it gave another signal right there. Right there, you got trend re-entered, trend, volume, momentum. Again, saying that this is a long move. Now what's the second time frame? Second time frame here says that you've got green volume, dark red heat map. Your third time frame is saying that you still have green volume. This is a much better place to enter. So Hawkeye gives you a defined entry point based upon not only your current volume and momentum, but on alignment of your multiple time frames. The multiple time frame keeps you out of chop, keeps you out of false entries, and helps to get you into a location where you have the highest probability of a continuation of the trend with the lowest amount of risk that you have on the trade. That's another reason why I like the roadkill indicator, because the roadkill indicator shows you that multiple time frame alignment on this same chart. So if I were to pull that up, let me see if I have a chart here that I might have that on. A 5-minute. I have two 15s on there, maybe not that one. There it is. Here's a 15-minute chart. On this 15-minute chart, I do have my roadkills loaded. So if I were trading the 15, 30, 60-minute time frames, then the roadkill shows me the alignment of those trends. So at this point here, you can see right there, that became the first point where everything was aligned on the 15-minute time frame. Okay, so the signal came right here, but that signal occurred where my momentum was red. I need to see a dark momentum or at least a bright green. And in this case, that occurred on the next price bar. This becomes my trigger bar, and my entry bar then becomes the next bar following that. Boom, right there. So that's why I like the roadkill. The roadkill helps me to see the alignment without having to worry about looking at the three charts. Although the alignment tool here is really good to help you to see that globally. The roadkill is an excellent tool to help you to see an exact alignment. Really nice. Besh, these blue, these are called Hawkeye zones. The zones are here to show you active supply and demand zones. So these show you where the buyers or sellers are historically have set and show the location of where you should expect to see price stall or reverse when those levels are hit. So when price trades back up again and back down to these regions, we expect price to reverse off of these, or at least stop and find support, or in this case, stop and find resistance. Especially when you start to see selling volume in a supply zone. That's really key, because if you're establishing highs with selling volume, that's a really, really clear sign for reversal. And yes, absolutely, these are available for MT4 as well. Incredibly valuable tool I would not trade without in my zones. Yes, the zones are available for NinjaTrader, MetaTrader 4, and TradeStation. We haven't made them for TradingView yet. Ernest, did I answer your specific question? I hope so. You're welcome. The indicator is called the Hawkeye zones. Good. What are my thoughts on Fibonacci? Fibonacci is a nice tool. I mean, it's very helpful to help to visualize things. Um, I I have it right here as a quick tool just to help me to put it on things. But if you're looking for retracements, then it's a great way to see those types of retracements. So putting a Fibonacci on a point can help you to see, based upon your retracement levels, where your sweet spot is. So this retracement got to a 50, 60% hot zone. It's a perfect retracement right at a zone. I mean, that's compared to the zones, that gives you really good idea where the pullback regions are. Okay, so this particular one was a very nice one. So you can see, based upon that same measure of pullback, you can measure that as far as a break and a profit take. You're looking at probably a 1.25 extension. So you're looking for at least about a 25% push above that zero mark for things. So yeah, there's a pretty good comparison on that too. These zones are definitive in that they show you where volume is resting. The Fibonacci just show you statistics for retracement and known uh, values, which have shown repetition. So these are all Fibonacci values that show a high degree of attractiveness to price. So yeah, use the tools that you've got to your advantage. Make use of any of the tools to help you to see. But the Hawkeye tools are unique in that they help you to define entries and exits uh, in a precise way, in a measured way, and in a way that helps to keep you in the trend for as long as the trend exists. And once the trend shows that it's not in that direction again, then it it lets you know very, very quickly. And yes, this is a supply zone, so that means that as price enters here, we expect it to either stall or to reverse. Now, if it doesn't, then and if this fails, then this is a failure in that price region. Then that failure is broken here, and then we expect it to go right back up into the previous zone, which is right next to it. So this then becomes a confluence zone, a much stronger region. So you can see that historically price has failed here multiple times and needs to be retested again. Yeah, the zones are not part of the professional package. It is a separate tool. We did not develop it. It was developed by another company, and we have purchased the rights to modify it, to rebrand it, and to market it ourselves. And we support it ourselves as well. But we did not write the code, so we can't make it part of our grouped packages. We have to sell it separately. John, using the basic package. Okay, basic being the standard, or basic being the starter package, like the volume. If you can be a little more specific on that. The starter package. Okay, volume only. Got it. All right. Any specific market you want to look at? Forex. Oh, futures. Okay, futures. Let me pull that on here. Forex, there's one. Okay, here's volume only. Let me turn off the auxiliary tools here. Okay, volume only. All right. Any specific future that you wanted to look for? Otherwise, we'll just pick any particular ones. NASDAQ, okay. ES, you want to look at ES? Okay. At the S&P. Here's the S&P 500 this morning. We're looking at a 3-minute time frame. You're looking at volume only. So here you can see the indicators I've got loaded up. I'll format my analysis techniques and show you. I have turned on, okay, only the Hawkeye volume paint bar, the volume radar, the pivots, the wide bar, and the volume paint bar. So you can see here's the volume radar. Here's the volume paint bar. Pivots and the wide bar will be the purple bars. I might not have the wide bar turned on. I don't. There it is. There's the wide bar. Okay, so let's walk through this. So let's look for that. Looking at the longer time frame, again, that'll help you to set that up. You can do this on any time frame that you're looking for, whether it's 12-minute, 60-minute, daily. The volume is very, very adjustable and will allow you to look at any of those things. Anytime this condition exists right here, when you start to see volume pushing up, when you have volume price extension, okay, here is a price extension on opposing volume. This is a, like you call it, a trick shot. This is the market saying, I'm pushing down to try to find attractive regions to buy up. But from the retail trader's perspective, they see this as a break new low. This is a breakout. I want to get short. But what the market makers are doing is that they're trying to create liquidity for their trades, and they're trying to get you to suck into that market. And then very, very quickly, they reverse it back up. So this is a clear indication that you've got a lot of trapped traders in here. And then once those trapped traders get to a certain pressure point, then you start to see all of them trying to get back out again. So you got to build up, block in, and then get out. And so this is showing you that pattern. After that occurs, it just holds, consolidates, and then it starts to go back in and retest. You've got clear support, you got clear resistance. Once that clear support resistance channel is broken, here you can start to see rising channels. Got it? Okay, you can see higher highs and higher lows forming, going through this. So outside of that, so you're starting to see a trend. Then here you've got another congestion. Now you're starting to see that congestion channel is broken by price breaking the prior pivot low. So the tools in the starter package give you everything you need to be able to analyze structure in the market from a volume perspective and price perspective to help you to take and to make these types of trades. So if you're just simply a structure guy and you're trying to draw trend lines or support and resistance lines, then the starter package helps you to start from that perspective to learn and to help you to get to the next step. Okay, just from simple trend lines alone. If you don't do anything else, at least learn how to, okay, draw a horizontal line on your chart. And when you see price starting to break that as a support level, that gives you a clear indication, especially if volume is supporting it, that that's the directional intent. The same thing with the trend line. If you can draw trend lines, then you can really help yourself by connecting the dots to see where price is really moving. And when that is broken, okay, and retested, then that tells you, okay, that's over. You're now consolidating, and then when that's broken, you're in a trend. So it's just a good way as a trader to learn to become disciplined, learning price and volume, and then from that, you can start applying the other tools that give you real definitive entry or exit marks. Following this method, the entry and exit isn't as definitive because if you sold on every red bar and bought on every green bar, you'd you'd be in trouble. It's not that black and white. This is really clear right here. Okay. This is a failure that becomes really clear, but with the aid of trend lines, then you can see very quickly where the definitive mark for a direction change is or where you want to enter or exit. But there are other tools that you can also use in line with that. That's why we created the Hawkeye trend, the Hawkeye stop to help you to define the entry, the Hawkeye heat map to help you to gauge the strength of the move, and then our methodology of using multiple time frames to help you to see and to get in with minimal risk and highest probability. Make sense? John, did that help any at all? So if I were to see this coming in and to make this as a trade, then I would have, if this is all I had, then I would be drawing trend lines. Okay, I'd be seeing this as a trend down. Okay, and then I would start to connect the dots. Okay, here's one trend right there, and then here's another one right here. Okay, and then so when I start to see these trend lines broken, it becomes quite easy for me to define whether I want to take that as a trade entry or not. Okay, so connecting these right here, you can see how price respected that. Connecting these, okay, that showed how price respected that. When that was violated with volume, confirming it, this gives you a high probability entry. Okay, this one supported it, tells you that if that did not break through that's corrective. This is a great place to sell. Okay, then as it came right back down and this price broke through that, boom, that becomes a value breakout, and this becomes a great place to buy. If that buy is supported with green volume, which in this case it is, then that becomes your signal to start getting in long again. So using volume and price only, looking at the chart, looking at structure, it helps you to see where those entry points would become. The different spots here on the volume indicator, these are volume radar dots. The red identifies ultra high volume, so it's relative ultra high volume. You can see that this isn't ultra high compared to this, but we're looking at that volume bar compared to the previous 20 price bars, volume bars coming into it. So this volume bar right here, right there, while it's low or high, it's relative to the other price bars, the other 21. It's very, very high, over twice the average height based upon the previous average 20 bars coming into that. So that's what red is. Yellow is very high, so it's not quite twice as high, but it's very high. This is ultra high. That's very high. They're both important. So this just gives you like a temperature gauge. That's high, which is significant, but that's very high. The blue is ultra low. So that means that you've got extremely low volume. When you see an extremely low volume bar, that tells you that there's nothing to indicate there's a direction going on. That just says that it's failing. The push in that direction or the push in that direction is just failing. A huge amount of downward volume on this bar right here. It's not followed by downward volume. It's a declining volume bar that's followed by extremely low volume, a whole series of extremely low volumes. Well, that's at the end of the day. So you expect to see that. Basically, at the end of every day, you're going to see that because this is where they do the exchange rates and the interest payouts. and there's no trading in that time frame. So that's basically reason why there's no market. And then this is also the Asian session, typically a very low market. And then for the S&P futures market, it's it's the start of Globex, so there's not a lot of activity on that. You usually will start to see activity in the Globex market occur during the London session or beyond. The amount of volume in the off hours and the amount of volume in the normal regular trading hours are significantly different, so you always have to look at that as well. This is the regular trading hours in the US session. These are the Globex hours, after hours. So that's what the different color means. Ultra low volume, ultra high volume, and very high volume. They're significant. That's when we point them out to you. And you need to be able to look at that relative to price to see how meaningful it is. What does a white volume bar with a red dot means? Okay, the white volume bar tells you that there is equal buyers and sellers, that there's a very even distribution, and the red dot tells you that there's a huge amount of them relative to the 20 price bars coming up into that. So that's what we're looking at. That tells you that there's a lot of interest, but it's very, very neutral. That's neutral volume telling you that there's no real bias towards buying or selling. So that's what the white volume means. White is general indication of no demand. No real demand for buying, no real demand on selling. So you're looking for no real direction from that price bar. If you see a big one with red, you expect it to go down. A big one for green, you expect it to go up. But there's always the failure. You always look for the failure. And you always will see these big bars at the end of a day because that's usually everybody normally day trading margin getting out at the end of the day. So that's why you'll always see big bars at the beginning and ending of a day because that's the start and end of the regular session. All right, Kay. And the same theory and analysis can work on any time frame. I just use it here on a 12-minute. You can use it on a 3-minute. You can use it on a daily. Here I can pull up a longer term using the exact same thing. This is a daily chart using Netflix. You can look at the same analysis to help you to identify the pullbacks low, the pullbacks high, the overall trends. You can connect the dots using your trend lines. If you're trying to learn and if you're a student, then you can see where the corrections occur, where the true breaks are with volume, telling you the direction that you're going in, great entry point, continuation. Okay, you can see the pullback there, great place to take a profit, but again, use the values to help you to see where the breaks occur. Connect your pivots as well. Okay, so one or two, either one of these become really great points for continuation and profit. The second one was the true break because look, that's the one that was retested right here. You can see price broke out, retested it, and then continued back on again. You can see consolidation range. Okay. There's that consolidation. There's your break of consolidation. Great entry point. Got another consolidation, a break of consolidation. Great entry point. I could go on all day. It's basic trading, understanding price and volume, basic structure analysis, the tools that we develop and make all that easier for you. Without having to go through the analysis of breaking the trade down, you look at the exact entry points. you'll see that these correspond with the alignment of volume and momentum on the longer time frames. It's basic Wyckoff, that's true. Traditional charting and Wyckoff, it fits exactly because that's what our tools are all based upon. Price and volume, John Wyckoff, and it's a really good way. Exactly. The yellow lines here, these are pivot extensions. They kind of make it easy for you because the two most recent pivot high or pivot lows are automatically drawn for you to show you either channels or high and low points. So it can kind of give you these types of channels automatically. Sometimes it doesn't. Like right now, the two previous pivots created like a nice support region, but it doesn't actually give you a channel that you trade in. So a lot of times they're real helpful. Sometimes they're not. They just show you where the previous structure high or lows points are. But the volume tool is foundational to, should be foundational to your basic trading methods. And it should be the tool that you use to confirm your trade entries. So if you don't have a trade entry that's confirmed by volume, you do well to get out of that trade. Long term, short term, mid term, forex, futures, doesn't matter. A lot of people say that there's no volume in forex. How can you do that? Well, there is, but the volume that we use is called tick count. So we use the tick count within the forex market in order to approximate true volume. If you used volume futures, like a currency futures, you could use true volume based upon those. But in the spot forex market, you do not have that. But what you do have is still every bit as good. We can do the exact same type of volume price analysis that we do to determine the color of each of the volume bars on any given price time frame. And we can do the exact same type of analysis to say where the false breakouts occur, where the sellers are stepping in and telling you this is a place attractive to sellers or this is a place attractive to buyers. And it's very easy and clear to see once you have the basic understanding. And yes, I provide this level of teaching free of charge every Wednesday for anyone to come in to see, to learn, and to understand. If you like what you see, then come into our store and purchase some of our software. We make a very attractive offer for our starter package to help get traders into the use of volume in their current trading methodology, whether they trade cryptocurrencies, forex, futures, stocks, whatever. Volume is the key. Volume on triple time frames will help you get to the point of learning and consistency in your profitability. So I hope you've learned something. I'll give you a little bit of taste of what is to come. We've got a whole suite of volume tools that we're going to be pulling out and releasing here in the very near future. So a lot of these are going to be extremely useful and helpful for you as a trader. So we'll help you to apply that to your market and to your charts. So I hope that helps. I'm done for the day. So let me go ahead and stop the recording at this point.